Thinking about tapping into your home equity? A HELOC or a home equity line of credit can be a smart, flexible way to access cash. But is it the right move for you? In this video, we're breaking down exactly how HELOCs work, how to use them strategically, and what you need to know before applying, especially in today's interest rate environment, with mortgage expert Caeli Ridge. If you want more content like this, make sure you like and subscribe to our channel. Okay, so Chaley, before we dive in, can you give us a quick definition of what a HELOC is and how it's different from a traditional home equity loan?
So when we think about a traditional home equity loan, HE loan, that's going to be a closed-ended mortgage. And more often than not, those are going to be in second lien position and very similar in structure to, say, a 30-year fixed mortgage. It's amortized and closed-ended. A HELOC, home equity line of credit, is open-ended and revolving. The other primary difference there is going to be the HE loan and a traditional 30-year fixed are interest rates are fixed, and a HELOC is going to be a variable interest rate.
I'm imagining this is an increasingly popular loan. I was having a call with a member just a couple days ago, and it seems to be more and more frequent. We all loved the run up in equity over the last couple years, but I think a lot of people are feeling house rich and cash flow poor, and they're looking for ways to tap into that. Have you seen an uptick in the volume of HELOCs that you're doing lately?
Massively, massively. Yes. I think that in the rate environment that we're in, people have been desperate to find solutions. And not only have they found HELOCs as a way to maintain higher cash flow for certain deals, tapping into that equity, but the principle and the concept behind some of the usage of HELOCs is really profound and not mainstream. A lot of people have really come online to understand the idea of velocity banking or infinity banking, which I think we'll probably get into at some point in this conversation.
So, what are people typically using HELOCs for in your experience? I mean, you deal pretty consistently with real estate investors like us, but are people using HELOCs for things other than investments?
Well, I think that the HELOC in it of itself is going to be such a unique tool for investors specifically for a couple of reasons. One, it gives you that open access to the equity, okay, versus it being that trapped in. The second thing is that you're only paying interest on monies that are in play, right? Versus an entire cash out refinance, you're going to get a lump sum of cash and the interest is going to start. So that would be another big win or advantage to the HELOC. People are using it for home improvement, obviously, the traditional stuff, investing clearly, whatever really they want to. It just is that flexibility and the access that they don't have otherwise. It may be important to mention too that HELOCs come in both first lien position and second lien position, and there's some distinct differences maybe we'll get into too.
Yeah, well, let's take that rabbit trail a little
Yeah,
bit. Let's talk
yeah.
about, the limitations with the HELOC. What type of property can you easily get a HELOC on, and what type is it more difficult?
So you can get either first lien or second lien through Ridge. We only have first lien HELOCs currently for second lien HELOCs. And what that means, just to make sure that it's clear, you have a first lien, whatever that may be, a 30-year or 15-year, whatever your first mortgage is, and then you go out and get a second mortgage in second lien position. That just means that if the loan defaults, that second lien will get paid next, right? They're not going to get paid first. So first and second lien. Now, the primary differences I'm going to say is that the first lien is going to give you more access. Generally speaking, I believe that the ideal or optimization of a HELOC is going to be where you can get the highest, largest credit limit available. In a second lien, you can probably guess it's going to be a smaller or shorter line of credit. The first lien is going to provide you for a much larger line of credit. The other things to consider in first and second lien is a second lien in that second lien position for the reasons I just described is going to come with higher interest rates.
So I think one of the most common times that we hear people mention HELOCs is, they're taking out a HELOC on their primary home and maybe using the money to, do improvements on that home. But I'm curious to know about the application of a HELOC for investors like us who are looking to maybe tap into equity on their primary, but maybe equity on other investment properties and use that as, dry powder to go and buy more investment property. Do you think that is a risky thing to do, to go and borrow again for more investments?
Absolutely not, for a few reasons. I am a huge fan of harvesting equity, whether it be in a primary residence or an investment property, which, by the way, HELOCs are available for all occupancies. Now, there may be some differences and restrictions depending on if it's an owner-occupied or a second home or an investment property. More often than not, those restrictions are going to have to do with loan to value, lower leverage opportunity on an investment property than you would find on a primary residence. But overall, I am a big, big fan of utilizing the equity in this way, because as I said a second ago, you're never going to pay interest on monies that are not being utilized. So to have this line of credit, let's just say it's $100,000, just for easy math. If you're going to leverage $20,000 to then go and apply it for another investment, you're only paying interest on that 20,000, which is a pretty big deal. And remember too, the other thing to consider is that all of this is tax deductible. These funds that are going to be used for investment purposes can be written off on that Schedule E for investors. So you get a line of credit, and it's interest only. Very important to comment on that. Interest only is the payment. The easy math, let's say the interest rate's 8%. And let's say I'm gonna pull out my handy dandy calculator. Okay, if you guys want to do this at home, follow along. Let's say I'm borrowing $20,000, okay, and my interest rate is 8%. You're gonna take $20,000 times 8% sign and divide that number by 12 months in a year. That's simple interest. That's $133 given my example, okay? 20,000 at 8% over divided by 12 months. Interest only is what you're going to be paying. Now, I do want to make a point about this, because sometimes people will push back and say, well, I'm not plunking down anything to the principal. Okay, fair. That's a fair comment. However, they aren't really finishing the sentence, because if you look at an amortized mortgage, let's just take the traditional 30-year fixed, that's 360 months. Most of us are probably aware where I'm going with this next series of commentary. The first 10 years of that 360 months, or the first 120 months, how much of your payment, have you looked at it, is going toward the principal?
None of it.
Very, very, very little. We don't start that because of the amortization length being so long. The reverse, where you're starting to really see more of the payment go to principal, doesn't happen until after that 10 years. And because the shelf life for most mortgages, in particular for an investment property, is about 5 years before we're refinancing to reduce an interest rate or to harvest equity, or we're selling 1031 exchanging, etc., that argument really doesn't hold water. Anyway, back to your question. So it's an interest only, whatever you're drawing, the interest rate at the time, you just divide by 12. And more often than not, HELOCs are going to be limited in how long you're going to have access. So I would say traditionally, second lien HELOCs have a 10-year window of access time, where after that 10 years, you no longer have any more access to the line of credit, and then it becomes a principal and interest payment for the remaining term.
I'm curious, have you ever seen an investor get themselves into hot water with this strategy? How does it go wrong?
It's a good question. I am searching the recesses of my mind. I don't have a good example that I would come back and say that an investor misused. Now, here's where, if we're going to play devil's advocate, here's what I would say about that. So for somebody that has that mentality where they say, well, what do you mean my checking account's overdrawn? I still have checks left, right? They may have an issue, right? If they're going to see this line of credit as just their own checking account where they can just use it for, vacations or shoe collection or, whatever it may be, then perhaps that's going to be an issue. But if it's exclusively for the purpose of real estate investing and their investment is sound and cash flowing, then no, I do not see a downside to that.
And how much variation should someone expect to see when considering different HELOCs? I know some HELOCs have adjustable interest rates. Some have fixed. I mean, what are some of the variables that people should be asking about and really shopping for before they do one?
So most lines of credit are going to be variable. I'm not familiar too much with the fixed HELOCs, what those terms would be. The variable piece, you're going to want to find out what the margin is, what the index is that it's tied to. Let's talk about the index for a second. So actually, let's talk about an adjustable rate mortgage, just basically in general. So when we talk about any adjustable rate mortgage, there are two primary components. There is an index and a margin. The index is adjustable. That is what will move up and down. The margin is fixed. So for however long you have this loan, that margin will never, ever change. The index is the one that will go up and down. And there's dozens and dozens of indices out there. The common ones that you will have heard most recently, the Fed fund rate is an index. That is actually the daily intra-trading rate between banks. Prime is an index. That's another common one. The US Treasury, that's an index. So depending on the index that it's tied to, I'd want to find out what that index was. If you want to do some due diligence, I would go back and look at the historical value of the index. That's going to be important. How often is it changing and by how much? You can get all that data online at your fingertips. Dear Google it. So yeah, the index is going to be important. Then find out what the margin is in relation to, because when you add those together, that's how you're going to figure out what your interest accrual is based off of.
Yeah, and I remind investors all the time that there are conservative ways to utilize a HELOC. I don't think you necessarily have to apply for the biggest HELOC that you could apply for and then deploy all of it. I think you can, like you said, use what you need when you need it. But I was having a conversation with actually one of our coworkers here at Real Wealth with Celia, who used this strategy to purchase an investment property. She got a HELOC on her primary, which had gone gangbusters, and used that money as a down payment on an investment property in Florida. And, the first couple years, actually, the first year, the cash flow was really good on this property. And actually, the cash flow covered her HELOC payment completely.
Yeah.
And then when things like property taxes were adjusted and insurance adjusted, she found herself kind of in the opposite situation and felt a little bit nervous or frantic about the fact that now she was having to write a check every month to cover the HELOC payment and negative cash flow on the deal. And I had to remind her one of the big benefits I see to the HELOC is that it's allowing you essentially to finance the down payment. Normally an investor has to have all this liquidity, in an account, and they're having to plop all of that, money all at once onto that investment, where she's able to almost pay it in a prorated sense.
Right.
Yes, paying it back to herself. Yes, interest for the convenience, but it's like putting it in the context like that for someone to understand the benefit, the cash flow, having more than enough to cover the HELOC and cash flow, to me seems maybe a little bit too good to be true if you also got to prorate the down payment expense. Am I thinking about that the right way?
No, I think that's a great point. And remember, and I know that I say this a lot, but don't forget about the tax advantage. Okay. I know it's not dollar for dollar, but I think a lot of times investors dismiss that or forget that they're going to have that incentive. And depending on where they are in their acquisition or their journey of real estate investing, and whether they're the real estate professional exempt or et cetera. I mean, I know that plays a role, but I think that's absolutely right. I think if you start out just out the gate and you know that you've got enough to cover and then some, what my conversations with investors usually surround is that right now they're not using that cash flow for their living expenses, right? They're going to stockpile and or use it to rapidly repay whatever they borrowed for that down payment on the HELOC. In a couple of years' time, when that happens, they're still going to have access to that HELOC that will make them good while they weather any market shift or change. So they can pull from that HELOC to cover those expenses because the balance has been repaid to a level that is more meaningful or more manageable, rather, in the overall deal, in the cash flow. So let me say that a different way. So if I borrowed $20,000 from my HELOC and I use that for a down payment, and on day one, I know that my cash flow is X. It's doing very, very well. And I've accounted for the interest payment on the HELOC. Forget about the tax benefit for a second, although you really shouldn't put that in there. But let's just say that you're doing very, very well. Most investors are not going to be using that cash, let's call it $200 a month, whatever the number is, for paying their groceries, or right? That's not typically what's happening at this point. If that's the case, then maybe it's a different conversation. But otherwise, they're taking that extra cash flow and they're applying it back every month with the interest only payment on the HELOC. The total difference goes straight towards the principal, reducing that principal in a much faster fashion than you would on an amortized fixed rate mortgage, right? So that in a year or 2 years, when things may have changed in that example that you gave, taxes went up, insurance went up, whatever, they have that margin or that spread from where they started, that $20,000. Maybe they've repaid it by $7,000. They can weather that storm until it shifts again, or until they've appreciated the rents, et cetera. So that might be my feedback.
That's a really good point. Okay, so last question on kind of the traditional HELOC. We're all, those of us who have a lot of the equity in homes, we also probably have really, really low interest rates, and that can feel like handcuffs sometimes. When is the tipping point when you need to just cut the cord on the low interest rate and stop considering the HELOC and just straight up refinance the loan and pull the cash out?
When the return of what you're getting is going to offset the increase in payment by X factor. And that's going to really be individual, right? What is their buy box? What is their threshold for risk, et cetera? The math shouldn't be too difficult. If I'm going to give up a 3% interest rate to pull $100,000 out, and that's going to increase my payment by $400 a month, whatever the number is, but this $100,000 is going to yield me $1,500 in cash flow, the math is pretty simple.
Right.
So I don't know if I'm answering the question, Leah, but I think that it depends on the individual and what they believe is appropriate for their return.
No, I think that's really the advice, in its simplest form is when you're considering HELOCs, doing the bottom line math, but maybe compare it to a straight up cash out refinance on the same loan. And then that
Sure.
way you can look at them side by side and make the easy mathematical decision about which one makes the
Great.
most financial sense, even if getting rid of that 3% interest rate feels painful.
Yeah. I have that conversation all the time. And, you know, there are other methods and ways that we can talk about diminishing interest accrual over time. But yeah, do the math. Do the math both ways. Look at it side by side, and then you can make informed decisions.
If you like this video and want to take action, go to realwealth.com/lender.